Hey, good afternoon, everyone. Marty Mazora here, July 6th, 2022, with your midweek stock market update. Also going to take a quick look at copper as well before we're through today. But we'll start with the S&P 500, as we've been doing for months now, and I'm just going to focus on the 60-minute chart, which is the one in front of you, and then the daily chart. Recall in my last update that I was pointing on this 60-minute chart again to this symmetrical triangle pattern, and I said that's a consolidation pattern and it could break out in either direction, and that these bullish divergences here, very distinct ones on my two momentum indicators, were actually suggesting that the break would be to the upside. And indeed, that's what we've gotten so far this week. Now I can essentially take our top line here and just kind of extend that out. So we're pretty much in that same pattern, but clearly, based on how we look at things technically, this would be bullish on balance, despite my skepticism over what I'm thinking early July would otherwise deliver. The technicals continue to look decent. Not as compelling as they were back here, and perhaps not as compelling as they were here, but still I could see why a technician would be bullish and maybe want to buy this, particularly if we break out above that resistance right there. And then on the 1-year daily chart, still have that constructive look, right? We've got our bullish divergences, higher low on the momentum indicators versus very definite lower here on the price chart. I pointed to these gaps already. I went ahead and put these rectangles in there just to highlight those. Recall, folks, where I was talking about this as, an area that could be resistance. Gaps almost always get filled, frankly, not 100% of the time probably, but most of the time. So we had this sell-off, we had this big gap down between sessions, and so that did indeed prove to be pretty good resistance. Now, we've done this one already, but sure enough, here we resisted it, struggled with a little bit, came back down, and now we're working our way back up right here. So, that could, if this continues at this pace and we go at kind of a normal angle, you could have the double resistance of the trend line, right, coming down here, a very definite downtrend, and this resistance to the top of this gap. Now we break through that, and then we've got, first of all, the bottom of this gap right here, and then the top. So this isn't an easy market, right, for the bulls, technically speaking. And we're still overall net bearish, I guess I'd say, because we do see lower lows from a probabilistic standpoint before this bear market ultimately plays itself out. But bear markets are generally replete with serious counter-trend rallies. And it's been fun to kind of point to these and anticipate those just so clients can gauge their expectations. Back on that one on the 60-minute chart, that 3,800 level, we did, because we were pretty heavily hedged, pretty close to the money, had a fair amount of our core portfolio capital in our S&P put hedge. We actually took on some calls there. We took a call position on the S&P to more or less hedge our hedge, and that worked out quite nicely. Being able to see that coming and feel as confident enough there that we could mitigate the hit that our puts would take that we want to keep or keep managing and keep rolling. In the event of a strong rally, we were able to mitigate most, if not all, of those losses on the puts there. We did that. We rolled those calls a few times. We took them off, I want to say, a week ago this Monday, so last Monday, and for the moment do not have those call positions on the S&P. We just don't have the kind of upside conviction, even though I am pointing to probabilities maybe leaning in that direction right now. We did, however, today add a call position on European stocks. Now, this comes from the 2 or 3 paragraphs that I omitted in this morning's note. And what I did this morning, for those of you who read it, you know this, I just copied and pasted from my last evening's log entry into the notes that we keep internally and I share with you from time to time. Now, I know I have non-subscribers watching this video. So folks, I have to emphasize, and I can't emphasize enough, that I am not making recommendations to you right here. This is really meant for clients, but we're happy to have people take a look, and if there's some helpful information, great. But do not engage in these markets without consulting your professional. My purpose here is really just to give clients some understanding of some of the forces, not just technical, but I've talked about things like options dealer positioning and how that can impact the market in big ways, like it did March of 2020 and like it did to some degree here this last month, and short covering and that sort of thing. I think it's important for investors who think about markets a lot to have what at least we view to be the proper perspective on the short-term gyrations, because you can misinterpret what they're suggesting and perhaps feel that what is truly just kind of a mechanical bounce in the market as the beginning of the next bull market and make big mistakes, or a strong sell-off that could be just options dealers having to hedge their downside position through shorting the underlying securities that they're insuring, just really exacerbating the downside. And we don't want clients, sitting there worrying about the notion that this is the beginning of the end of the world or something. So our job is, manyfold, but part of it is to understand the underlying structures as best we can and anticipate the kind of volatility that's going to come from that and articulate that to the people who pay us to manage their fortunes and who pay a lot of attention to markets at the same time. Again, in a nutshell, U.S. stocks vis-a-vis the S&P 500 right here on a short-term basis. On balance, I think you can be constructive. Do not be surprised if any day, tomorrow, what have you, you see a big washout to the downside. This is kind of a funky time of year. A lot of traders are on vacation, so that means less liquidity. You can get some strange moves in either direction. We're in a bear market, and we're going to be in a bear market until the data and the trends tell us that we're not. And that means, lower lows with these counter trend rallies along the way. Okay, so let's just talk a little bit about copper. I tend to do this during the macro presentation, but I thought I'd do this today because copper is just getting taken to the woodshed. Now we have copper futures in an ETF. We have the miners, which we just added to a little bit here recently. We have the S&P Materials ETF. So we have a decent chunk of our core portfolio correlated to things like the price of copper. So I wanted to talk through this because recall, folks, when this was happening, I was telling you this is unsustainable and we're going to get a good correction come heck or high water. And of course we did. Up in here, same kind of story. Down in here, we kind of anticipated this pop, and I said this could go a little while, and I'm going to talk about what these headlines and why that had something to do with my anticipation there. I also did say it's looking like a bear flag. Sure enough, it played out right to the target, and then kaboom, we shot through what I thought would be some resistance right here at $8,000 a ton. And so we're sitting here at 78.01, right? Okay, so what happened up in here? To preface this, keep in mind that China has been the consumer of significant portion of the world's metals, industrial metals production, particularly copper, over many years now. On March 28th, the news was China is shutting down Shanghai, and copper promptly careened lower, right? Stopped dead in its tracks, the fall right here on this news on May 12th. China to end lockdown, okay? But then on June 9th, right here, Shanghai requires a negative test to access public spaces. Okay, kaboom. June 14th, China turns to mass testing. And then kaboom, and then tried to find some support right in here. Yesterday, Shanghai mass testing sends shivers through Chinese markets, but also through the copper market as well. So, folks, I think you can take it for granted that this is not going to go on ad infinitum. We've talked about Xi's political incentives that really come to a head a little later in the second half of this year. He stated recently that China is going to meet its GDP goal for the year. I'd say that's a virtual impossibility after the first half. But try as they may, they have been dialing up quite a bit of money to be spent on infrastructure, giving tax incentives for various projects. They're trying to inspire Chinese consumers to begin spending money through all kinds of tax breaks and incentives and so on. And they're still talking about mass testing. We'll see if they shut back down because they've been catching these pockets of positive tests for COVID. I don't think it goes on much longer, but I could be wrong. One geopolitical analyst who I have a great deal of respect for says this ain't going away till after Xi gets reappointed. And so I'm skeptical that they're not going to find an excuse or tell a story that's going to allow them to open up in a bigger fashion and really pound on the stimulus to try to get some positive movement from the Chinese economy, which has to play well, I think, into industrial metals, copper in particular. So this is not a position that we want to waver from right here. And our long-term thesis remains very much intact. And just quickly to give support to that, this was news this morning. Shell plc has decided to proceed with building Europe's largest plant-producing hydrogen from renewable power as oil majors bet the fuel could be key to cutting carbon emissions. This is going to be 10 times larger than any existing green hydrogen facility in Europe. Folks, these projects take incredible amounts of metal. Copper is right there at the top of that list. So, and we know this is a global campaign that isn't going anywhere. So the pressure on metals and rare earth minerals and that sort of thing, but in particular for these kinds of construction jobs, metals like copper is going to be enormous in the years to come. You've got Chile and Peru, something like 40% of the world's copper comes out of those two countries. Just elected new political regimes that are very populist minded. These are all things that potentially put upward pressure on the price of copper. And of course, miners got way out over their skis as China was building ghost cities and got stupid, frankly, and have paid the price over the last 10, 12 years. And now we're looking at lean companies that produce huge free cash flow that look very attractive from a long-term investment perspective. Also, with regard to that, I dialed up this chart. Copper futures among non-commercial futures traders, so speculators, are sitting right here betting that copper is going to continue to fall, and I can assure you, largely due to those headlines. So when you're short something, you've sold it, but you have to buy it back and give it back to the entity you borrowed it from. And so we get a little good news. China says, cases are down to zero, or we're not going to shut down, and we're going to spend $1 bazillion on infrastructure. Well, then copper is going to ramp higher, and that kind of short squeeze is going to exacerbate the upside. So probably some very interesting things to the upside over the next few months in copper. Doesn't mean it can't go lower, along the way or in the meantime or what have you. And then lastly, just to digress back to stocks, the S&P 500 E-mini futures last week really got short, right? So, this is pessimism. Again, as I've intimated, pessimism that I've shared going into July. Well, obviously, futures traders in the S&P shared that pessimism, and therefore we're shorting the S&P quite aggressively, right? So little good news, whatever it may be, could be weak economic data, could be a weak jobs number on Friday. Why would that be good news? Because it will send a signal to the market that believes that there's a signal to the Fed that maybe they don't go 75 basis points this month on a rate hike. Maybe they go 50 basis points. That might be bullish for stocks. I don't know. I could come up with a number of things. Resolution in Russia and Ukraine. Which reminds me of what I started to talk about and what we did with Europe today. I didn't finish that story. I'll finish that when I close. But so, folks, there's a potential for some short covering that could make these technical charts that are somewhat bullish, at least on the short term, come to fruition if shorts are forced to cover right here. Back to what I started to tell you about Europe. I got off track. So we cut half of our Eurozone exposure. I wrote about that this morning. Europe is a hot mess. There's no ifs, ands, or buts about it. Energy policy, you name it, is scary when you think about what Europe's going to have to face this summer and natural gas supply, lack thereof. So even though we're very constructive on non-US equities, Asia, Europe, emerging markets, for the next number of years, the next number of weeks and months, we've got some concerns. So we sold half of our Eurozone exposure today, took half of it and just stuck it in cash to be ready, because this market will bottom at some point. We'll want to have some more cash to allocate. And the remaining half, split it between consumer staples and, believe it or not, tech stocks. So staples are down about 5% this year, so they've held up crazy well relative to the rest of the market. The average portfolio, according to CNBC, I was told, so far this year is down 25 to 30%. Thankfully, clients, our core is down, as you know, a lot less than that. Tech stocks are down almost 30% on the year. We're constructive on tech in a world where the economy is slowing and interest rates are not ramping higher and inflation is coming off the boil. Tech is among the longest duration stocks, so it makes them very interest rate sensitive. So it's one of our smallest allocations, but we bumped it up a little bit today, and we felt pretty good about doing that. Not that it couldn't go lower, but we felt better about doing that than owning as much Eurozone as we've owned. Now, having said that, here's my concern with dumping half of Eurozone. Again, we're constructive. They're long-term. Stocks look valuable. Dividends are attractive. A lot of problems, but there's always a lot of problems in situations that look very attractive, typically, right? Because that's what makes them cheap. But just one example, I have no reason to think this is happening anytime soon, other than what I've already shared with you about some comments from Putin a couple of weeks ago, interesting action in grain futures and so on. Maybe some hints that there's been some talk of how to end this conflict. If talk of ending the conflict actually came to fruition, you can only imagine, at a minimum, the short-term rally that you'll see across Eurozone equities, right? We don't want to cut half our exposure and then have that happen tomorrow and then miss out on half of the gains we would have otherwise had. So not that we're anticipating that, and obviously we weren't comfortable with the exposure that we have in light of what I just said. So what we did with a little bit of the cash that we didn't allocate to anything else is we bought options, just one strike out of the money. So the FEZ, our Eurozone ETF, is trading at like 33.50. We bought 34 strike calls due, at least initially, in September. We'll keep them and roll them if we want to continue to keep that position. So we bought call options to control the number of shares that we just sold at 34. It literally was just a fraction of the actual capital that we collected by selling we used to buy this option. So what happens is, if, in my example, just one potential example, Russia-Ukraine ceasefire, if indeed there is going to be a big rally, we're going to capture a noticeable portion of what we would have captured by having all that risk tied up in the Eurozone stocks. So call it a synthetic replacement of what we just sold. We feel good about that now. Again, all that I didn't want to put in writing, but I'm comfortable saying it because here I can say to you, anybody who's a non-client listening to this, I'm telling you, don't get cute unless you really know what you're doing. Or if you have advisors who really know what they're doing, you want to share something like that, go ahead, but I'm not rubber stamping anything or making a recommendation to anybody. So folks, that went way long. I'll edit it down as much as I can while still making my points. I'll leave it there. Thank you, as always, for watching and listening. Hope you have a wonderful evening. Take care. Bye-bye.